Market breadth, refers to the overall health and strengths of a financial market. The overall health, the overall strength of of a financial market is referred to as market breadth. It is based on the number of stocks or securities, participating in a particular trend. When there's a trend, whenever there's a trend in the market, a number of stocks would participate. A number of securities would participate in that trend. It could be an upward trend, it could be a downward trend. And so the number of securities participating in that trend, in that given trend, will then define the market breadth at that particular point in time. So it provides insight into where, or whether a market movement is upward or downward, and is supported by a broad group of stocks or just a few leading ones. Generally, whenever there's a trend, how many stocks are involved, in that trend. Is it a downward trend, or is it an upward trend? Okay, and so what are a number of stocks that are kind of participants in that upward or downward trend? As I told us earlier, that will define or determine the market breadth. And so in this particular video, we want to consider how market breadths, are indicators can guide your investment strategies. There are particular indicators that will tell you precisely the market breadth at a particular point in time. At any given time, these indicators are there to give you a clear-cut ideas of the market breadth at that moment. We want to look at futures of market breadth. Please don't forget to subscribe to this channel and like this video. Make a comment in the comment section, and that will do me tons of good. Number one is breadth indicators. I want to look at breadth indicators. So in this context, you have advancing versus declining issues. Advancing versus declining issues. So this particular factor measures the number of stocks advancing versus those who are declining, giving us a sense of the overall market momentum. The number of advancing versus declining stocks in the market. You equally have what is called volume breadth. Volume breadth. Volume breadth examines the volume of advancing versus declining stocks, offering insight into the strength of the market movement. What exactly is the volume, of advancing stocks, stocks who are going up in price, and the volume of stocks that are coming down in price. That's a very important indicator you should consider as an investor or even as a trader. Number two is market participation. Market participation. So in this context, it refers to the extent of participation across various sectors or stocks. So a broad market rally means many stocks are involved. When I talk about that, when we consider a broad market rally, it means the majority of stocks are involved in the rally. And so a narrow rally may suggest fewer stocks, and a broader rally will suggest a bigger number of stocks, and that will determine precisely the market breadth at that instance. So what the nature of the rally? Is it driven by a few number of stocks, or is it driven by the majority of stocks in the market? You ask yourself that particular question. Number three is market internals. Market internals. So it includes the number of stocks, stock markets, high versus new lows. The other internal indicators that track market breadth and strength. Actually, when you talk about new high and new lows, it's an inherent feature of the market. Some stocks will make new highs, while some other ones will make new lows. So you now determine the number of stocks making new highs and the number of stocks making new lows. That will give an idea of the overall market breadth, and that could guide the decision making when it comes to your stock picking as an investor. Number four is is bread trust. Bread trust. A divergence occurs, when market breadth indicators move in the opposite direction of major market indices, signaling, potential reversals or weaknesses in the current trend. Generally, whenever there's a trend, either upward or downward, you see the overall market indices sometimes might contradict the movement of the trend. If a trend is going upward and the overall market indices is going downward, then that trend is not sustainable. It could be a short-term trend. And if there's a downward trend actually, and the overall indices in the markets is going upward, then that downward trend is not sustainable. It will bounce back at a point in time. And so that's what is called, bread trust. Or rather, what is called divergence, a divergence between the movement of the indices or index versus the movement of the trend. Number 6 is sectoral breadth. Sectoral breadth. So in this case, it evaluates how many sectors of the market are participating in a trend. How many sectors? The markets, like the US market design, they have about 11 or so sectors. Nigeria market also a similar number also. And so how many sectors are actually participating in that, in that trend? All right. So a broad participation across sectors indicates healthy, market conditions. If maybe you have, let's take a particular, let's say you have 10 sectors in the market, in a given stock market, all right, and about 7 or 8 are participating, in a trend. That's a healthy participation. If it is just 3 or 2 or 4 are participating in the trend, that trend will not be sustainable. It will not. So you consider what is called the sectoral breadth. How many sectors are participating in the trend? If many sectors are participating, wow, that means the market is, on a bullish mode. Number 7 is global breadth. Global breadth. So in this case, we talk about, a global event. All right. So in this case, there's expansion beyond domestic markets, looking at how various international markets, contribute to global economic trend. So in this case, you consider other countries as well. How are other countries' markets, doing? Just go through your internet, go through your apps or other financial news. You could have an idea of how countries are faring economically and how their stock markets are equally, faring. The returns in those markets as at when you access the information. So in that case, you consider global breadth. Number 8 is confirmation of market trends. Confirmation of market trends. So market breadth can confirm trends. Strong breadth supports the current trend, while weak breadth may indicate the trend is losing strength. Actually, just like the issue of divergence, okay, usually if you want to confirm a trend, you confirm it through what? Through the data from the indices. All right. If the indices or the index, as the case may be, is on an upward trend, all right, and then there's also an upward trend in the market, that particular trend is solid, is strong, it has an anchor, it has, a solid foundation. But if there's that particular divergence, then of course that trend is not confirmed. It will not really last long because the indices is saying another thing, and the market trend is also indicating another, is going in the opposite direction. That's a warning, that's a red flag for investors. Number 9 is advanced decline line. Advanced decline line. So any key, a key indicator used to track the cumulative differences between advancing and declining stocks, providing a clear picture of market health. Generally, you have some stocks, will advance, some other ones will decline, and some other ones will stay neutral. So you consider the ratio of the advancing stocks against the stocks that are declining, advancing stocks against declining stocks. And so if you have, a bigger number of stocks advancing, that's a wonderful market. All right. If you have a larger portion of stocks declining, that's not so good a market. That's a bearish market. All right, and so that indicator is very, very important. Advancing, versus the declining line. So it provides a clear picture of the overall market health. If you have most stocks advancing, that's a sign of good health. If you have majority of stocks declining, that's a stock of poor health in the market. So we talk about number 10, overbought, stroke oversold conditions. Overbought stroke undersold conditions. So in this case, this particular indicator can highlight overbought or oversold conditions, signaling when a market might be due for correction. When we talk about overbought, that means that there's a net buying behavior in the market. When we talk about oversold, there's a net selling pressure in the market. So whenever there's a net selling pressure, the market will tend to tank. Stocks will drop. Whenever there's a net buying behavior, the market will do what? The market will climb. So in this case, you look at the overbought and the oversold conditions in the market. So that's why you need to be very conversant with market breadth. It will go a long way in helping you as an investor. This channel actually is designed to really help you and to give you the in-depth knowledge you need to succeed as an investor. I don't give stock recommendations. No, I don't do it here. I would rather teach you how to fish than to give you fish. For how long will I be giving you fish? But once you are taught how to fish and you can fish for yourself, you are okay. That's the essence of this particular channel. Thank you very much for watching.